All right, let's dive into Sunoco LP's second quarter earnings. Now, this was a report that sent some seriously mixed signals to the market. On one hand, you had management talking up a record quarter, but on the other hand, the headline numbers? Well, they told a completely different story. So let's break it down and figure out which signal investors should really be paying attention to.
And this slide right here gets to the very heart of the confusion. What investors saw first was a huge miss on GAAP earnings. I mean, it fell short by $1.35, that's big. But at the exact same time, management was out there celebrating a record quarter, pointing to a 16% jump in adjusted EBITDA. So how can both possibly be true? Well, it all comes down to what you're measuring. GAAP earnings can get messy with one-time costs, while adjusted EBITDA is supposed to show the real, core earning power of the business. The question is, which number is telling the true story?
Okay, so first up, let's look at the numbers that really grab the headlines and, spook the market a little bit.
Yeah, you are seeing that right. The scale of this earnings miss is pretty wild. Just a year ago, Sunoco posted an impressive $3.85 in GAAP EPS. The street was expecting a solid, $1.68 this quarter, but the actual number, it came in at just 33 cents. That is a massive, massive drop, and you can see why it was the number that grabbed all the attention.
So how did the market react? Well, pretty cautiously. The stock dipped just over 1% on the day. Now, it wasn't a total crash, but it definitely shows that investors were looking at that big EPS miss and weighing it pretty heavily, maybe more heavily than management's optimism. They were trying to figure out what was really going on under the hood.
And to find that real story, we have to look deeper, because Sunoco is really a tale of two very different businesses running at the same time. And that's where you find the answer to this whole disconnect.
Okay, so here's where that record-adjusted EBITDA came from. Check out these numbers. The performance from their stable, fee-based businesses was just incredible. The pipeline systems EBITDA, it shot up a staggering 59% from last year. And the terminal segment, even better, up 65%. That kind of strength was more than enough to cover for a, let's say, softer performance in their more variable fuel distribution business.
So what do we mean by softer performance in fuel distribution? Well, the key number to watch there is cents per gallon, or CPG. Think of it as their profit margin on every single gallon of fuel they sell. And as you can see, that number dropped from 11.8 cents last year down to 10.5 cents this quarter. Now, management did explain that this was partly due to some strategic moves, like selling off certain assets, but it still put pressure on that headline earnings number.
And this really gets us to the most important point. None of this is happening by accident. Sunoco is very, very intentionally shifting its business model. This quote from management says it all. They are purposefully tilting the company away from that variable fuel business and toward the much more predictable cash flows that come from their pipelines and terminals. It's all about creating steadier, higher quality earnings for the long haul.
Now, this big strategic shift, it's about to get a massive shot in the arm with the company's next major move, the acquisition of Parkland. Make no mistake, the Parkland deal is an absolute game changer for Sunoco. This isn't just some small acquisition. It's a truly transformative step that's going to cement their pivot into the midstream and logistics space. We're talking about creating one of the biggest refined product networks in the entire Western Hemisphere.
And it's not just management that believes in this move. Look at this. 93% of shareholders voted in favor of the merger. That is an overwhelming vote of confidence. It tells you that the investors who've really done their homework on the strategy, they get the long-term vision, and they are fully on board.
So looking ahead, what should you be watching for? Well, here are the key catalysts on the horizon. The big one, of course, is in Q4 when the Parkland and Tinquin deals are expected to close. Then the real test begins in 2026. We need to see updates on them hitting that $250 million synergy target. That number is absolutely crucial. All the while, the company is aiming to keep up its track record of growing that quarterly distribution. And here's the kicker. Despite all the noise from that Q2 headline miss, management's confidence is completely unshaken. They came out and reaffirmed their full-year guidance for adjusted EBITDA. That's a huge signal that in their eyes, the underlying business is performing exactly as it should be, and their big strategic pivot is right on track.
All right, so after piecing all of this together, the good, the bad, and the strategic, we come to our take on what's next for Sunoco.
This is the big question, right? What does all this mean for the company and for its stock? Where are we headed from here?
Here is our prediction. First, for the next quarter's results, we expect that powerful performance from the midstream segments, the pipelines and terminals, to keep on rolling. Management is also guiding for the fuel distribution business to have a better second half of the year. Now for the stock itself, We think it's probably going to trade in a range for a while. Why? Because the market has heard the story and now it needs to see the proof. And that brings us to the key variable: execution. It is all about delivering on the promises of that Parkland merger.
So our final rating is market perform. Look, Sunoco is on a very solid strategic path. They're transforming the business into a higher quality, more stable operator, but the market is going to stay in wait-and-see mode until the company proves it can really execute and integrate Parkland effectively. The vision is compelling, for sure, but that execution risk is what keeps it from an outperform rating for now. The story is good, but the next most important chapter has yet to be written.
This is not financial advice.